Subscribe to my channel Report Stock.
Imagine an energy giant, not just holding steady, but absolutely smashing its own production records, all while trying to figure out this low-carbon future thing. How do they even balance that? Welcome to the deep dive. Today, we're plunging into ExxonMobil's Q2 2025 earnings call. Our mission, to sift through all the talk, all the numbers, and pull out the key takeaways for you. We're talking production milestones, strategy shifts, and the roadblocks they're hitting on that lower carbon path. Think of it like a peek behind the curtain, right? Understanding the strategy, the challenges, straight from the top. Okay, let's unpack this first bit. ExxonMobil's second quarter 2025. Production-wise, it was, a record setter.
Yeah, highest Q2 production they've had since the Exxon and Mobil merger. That's over 25 years ago.
Wow. But they stressed something specific, didn't they? That over half came from high-return advantaged assets. What does that actually mean, advantaged?
It's really about the economics. These are assets where they can get oil and gas out cheaper, maybe the quality is better, or they already have infrastructure in place, cuts down the capital needed. It's like their prime spots.
Their best fields, basically. Makes sense.
Yeah, where they get the most bang for their buck, even if prices fluctuate.
Okay, and speaking of prime spots, Guyana, that really stands out.
Definitely.
They're pulling, roughly 650,000 gross barrels a day from just 3 projects there.
That's right. Huge numbers.
And get this, the fourth one, Yellowtail. It's apparently coming online ahead of schedule and under budget.
Which is, that's pretty remarkable in this industry.
It's a massive win, isn't it? What does hitting those kinds of targets tell us about how they operate?
It says a lot about their project execution skills, especially in that complex offshore environment. Delivering these huge multi-billion-dollar things early and under budget, that seriously boosts the project's value and, frankly, builds confidence for the next ones. It shows they've got that part dialed in.
Absolutely. And this focus, this advantaged asset idea, it's not just Guyana. Look at the Permian Basin.
Still a powerhouse for them.
About 1.6 million oil equivalent barrels a day in Q2. But the big number is the planned grow about to 2.3 million by 2030.
That's ambitious.
Yeah.
Especially for a basin some people thought was maybe nearing its peak.
Right. So how are they planning to pull that off? Is it just drilling like crazy?
Not just drilling more, but drilling smarter. Technology is the key driver here. They mentioned getting 20% better recovery rates using things like lightweight proppants.
Proppants. Those are the little things they pump down to keep the cracks open, right?
Exactly. And these lightweight ones can travel further into the rock, opening up areas they couldn't reach effectively before. It changes the game, lets them get significantly more oil out of the same well.
Ah, so it's making the existing wells much more productive.
Precisely. And that's why CEO Darren Wood said they have a, quote, different view on the Permian's potential. They think the tech unlocks more than maybe others do.
Fascinating. Okay, so huge production now. But what about tomorrow? This is where it gets really interesting, I think. They're expecting their 2025 project startups, these new projects, to add over $3 billion in earnings in 2026. Just like that.
Yeah, assuming prices and margins hold steady, of course. But still, that's a big, quick impact.
How do new projects translate into earnings so fast?
It points to really efficient capital deployment. They're picking projects that don't just sit there costing money for years. These are investments designed to start paying back quickly. Shows discipline in selection and execution, getting that cash flow going.
And it looks like it's not just, oil and gas exploration. They mentioned expanding product solutions, new projects in China, Singapore, the UK.
Right. That's about moving up the value chain.
Meaning
taking basic oil and gas molecules and turning them into more valuable stuff. Specialty chemicals, advanced lubricants, polymers, things that sell for higher margins than just crude oil. It's diversifying beyond just the raw commodity. Optimizing the whole process from wellhead to, finished product.
Which ties into their M&A approach, doesn't it? Darren Woods talked about this.
He did. Made it clear it wasn't just about buying barrels.
Yeah, he said it's about leveraging their unique capabilities, creating value beyond the sum of the parts. The Pioneer deal was the big example.
Definitely. Those synergy estimates went from $2 billion a year
up to $3 billion now. That's a 50% jump. What does that suggest about how they integrate these acquisitions?
It suggests they're very, very good at it. Hitting synergy targets is tough. Beating them by that much is rare. It means they can quickly apply their own tech, their operating models, find efficiencies, really unlock extra value from the assets they buy.
So it's not just buying, it's improving.
Exactly. And Wood stressed that they're looking for these value deals everywhere, not just upstream oil and gas, chemicals, low carbon, whatever fits their capability.
That seems like a real edge. And downstream, refining,
Right.
they mentioned successes like Strathcona and Singapore,
Similar theme there.
converting low-value stuff into high-value products, often using existing sites.
Right. Upgrading existing refineries is often cheaper and faster than building brand new ones from scratch. It gives them flexibility to adapt. If the market wants more biofuels or needs solutions for plastic recycling, they can potentially pivot their existing infrastructure.
That centralized projects team they mentioned probably helps keep that consistent.
I'd imagine so. Coordination across these complex upgrades is key.
Okay, so mastering today's energy, check. Planning for tomorrow's earnings, check. But then there's the big one, the low-carbon future. Let's pivot to their low-carbon solutions business. Some real progress, but also some definite headwinds.
A real mixed bag, it sounds like.
On the plus side, their first third-party carbon capture and storage project is up and running.
Yeah, capable of storing up to 2 million metric tons of CO2 a year. And crucially, it's for other companies' emissions.
And they've apparently lined up nearly 10 million tons per year in potential third-party business, signed some contracts already.
That's significant. What does it mean for a company like ExxonMobil to be running a third-party CCS business?
Well, what does it mean? Is this the start of a real market?
It certainly suggests one is emerging. Moving CCS from just managing their own emissions to selling it as a service, that implies they see a viable business model there. Getting actual customers signed up is the proof point. It shifts CCS from just a cost, potentially, towards being a revenue stream. That's huge for scaling it up.
A potential profit center. Interesting. But it's not all straightforward, is it?
Apparently not.
They hit hurdles with that Baytown hydrogen plant. Seems like changes in tax credit timelines are causing issues.
Yeah, that policy uncertainty is a killer for these big long-term investments.
They sounded pretty cautious, wanting to develop a market-driven business for hydrogen, needing buyers locked in before they spend billions.
And you can understand why. If the rules of the game, like tax credits, keep changing, it's incredibly risky to commit that kind of capital. They need to see real committed demand and stable policy before they go all in on something like low-carbon hydrogen. It's that tension between the ambition and the hard economics.
And it wasn't just hydrogen, lithium development. Potential delays there, too, trying to get costs down to compete globally.
Right. Another area where the technology is maybe promising, but the path to being cost competitive is still being worked out.
Even exploring low-carbon data centers, but again, with a laser focus on cost. It seems cost is the common thread, the big hurdle.
Well, yeah. Unlike oil and gas, where you have decades of infrastructure and established markets, these new low-carbon techs are still scaling up. The initial costs are high. They need massive cost reductions or continued policy support, or ideally both, to really compete head-to-head and build that market demand. It's that classic chicken and egg situation.
You really see the balancing act there. Okay, beyond low carbon, there were other bumps mentioned. That arbitration decision in Guyana, they called it unexpected and disappointing. Pretty strong words.
Very strong. Losing a contractual fight like that on a massive project?
Yeah.
Yeah, that's a significant setback.
What's the takeaway there? Just the risk of doing business internationally.
Pretty much. It highlights that even with huge legal teams and carefully drafted contracts, interpretations can differ and things can go against you. It's a reminder of the inherent risks in these giant long-term international deals. You need robust risk planning.
And lastly, the chemicals market. Sounds like it's tough going there.
Yeah, low margins, too much supply. And they seem worried it might stick around for a while.
How much does a downturn in chemicals hurt a giant like ExxonMobil?
Well, it definitely drags on overall profitability. Even if upstream oil is booming, if your chemicals division is struggling, it pulls down the average. Shows that even diversification doesn't make you immune to specific sector downturns. They have to manage those cycles across the board.
So putting it all together, what's the picture? You see this immense success in the core business, right? Record production.
Absolutely. Firing on all cylinders there.
And this clear strategy to grow value through smart investments, M&A integration, moving up the product chain.
Definitely focus on efficiency and higher margins.
But then you also see the very real challenges and risks. Market volatility in chemicals, legal setbacks like in Guyana.
And of course, the big one. Navigating that incredibly complex, expensive, and uncertain path towards lower carbon solutions like CCS and hydrogen.
Yeah.
It's the full spectrum.
So, to wrap it up for you listening, we saw ExxonMobil hitting record production, driven by those key advantaged assets. We saw their strategy for future earnings, focusing on project execution, smart M&A, and higher value products. And we explored their progress in carbon capture, actually getting a third-party project running, but also the real struggles with making things like low-carbon hydrogen and lithium work economically alongside those broader market headwinds. Hopefully, this deep dive gives you that shortcut moving past the headlines to see the nuances of how a company like this operates and strategizes. Now, here's something to mull over after we finish. Given ExxonMobil's sheer scale, capital, and tech know-how, how might the successful scaling of carbon capture, which seems maybe a bit more tangible right now, versus the slower development of new hydrogen markets, how might that difference actually reshape the whole energy landscape and maybe even our climate strategies over the next 10 years or so? Something to think about.
Subscribe to my channel Report Stock.